Nice. We're looking good. What's going on, value investors? And happy Friday to you. I'm bringing you a live showing, a live review of Apple. We're going to be taking a look at their financials. I wanted to dive a little deeper and have this completely informal. I'll get to some things that I can't really get to when when I'm filming and producing videos. So I thought I'd come to you in this format, be a bit more personal with you guys, get to know some of you. We're going to dive in. And well, before we dive in, I have a couple things I want to go over. So let me introduce myself first. My name is Brenden. If you guys are new to the channel, welcome to my channel. Go ahead and subscribe if you're interested in learning more about intrinsic values, fundamental analysis. I have about 100 videos uploaded now where I go over the intrinsic value of companies and how to identify them. Today, let's see, we're going to be diving deep into Apple. And I want to take a moment, too, to address what happened yesterday unfortunately, in our nation's capital. I'm grieving. It hurts. And I'm sure you guys are grieving, too. I definitely couldn't start something like this without talking about that. But I definitely think that there's dignity to be had in hard work. And that much is evident if you look at the DJIA and the S&P 500 and other performance uh, uh, if you just go on Google, you look at what the business universe, the business world is doing now, they're pushing forward. And I think we should do the same, just out of respect for our great country. And I really think that that's the best way to go about this. I can't remember where I heard this from, but when other people are losing their heads, matter of fact, I remember it's from the poem If by Rudyard Kipling. When people are losing their heads, you have to hold yours a little tighter. So we'll just push forward in that light, in that spirit. But my hearts go out to the people who lost their lives in that terrible tragedy, and I know we'll get through this as a great country together. So we'll push forward. I'm going to change the scene a bit, and I want to tell you guys, as I'm changing the scene, I plan to go till 8. If we get done sooner, then that's fine. But if not, or rather, if we get done sooner and we have a little bit of time at the end, then I'm going to be monitoring the chat to see if you guys have any requests or any interest in, getting the analysis done for any particular company. Let's see if I can do this successfully. This will be the first time that I'm doing this, so you guys are learning right alongside with me. Hopefully it works. Let's see where we're at. I've got a delay here. Nice. It's looking good on my end. Okay. So what we are going to do first is we're going to take a look at Apple's 10K. So looks like in September, October, they filed their 10K. If you guys don't know how to get to the 10K, or if you don't know what the 10K is, the 10K is basically just a review of their financial performance. And as investors, as responsible investors, it's our job to read the 10K in its entirety. I know it's cumbersome, but Apple does a great job of making it concise. It's our job to review their fiscal year performance to make sure that everything is on the up and up, because it'd be irresponsible if we were fielding an investment in Apple or really in any company and we didn't do our due diligence here. So the way you can get to the 10K is if you just go to Google, you type in Apple 10K, and then it's going to be literally the first link. You click that. There's going to be a whole bunch of files. You just scroll down to where it says 10K for 2020 near September, October. And then once you do that, you can scroll down to page 3 on the document, and you'll see the table of contents. If you've never looked at something like this before, then I want to talk about what this all means. If you already know what this is, then just bear with me. But some of the most important items that I look at on a 10K statement are going to be item 1 when I'm getting introduced to a company. Item 1 is business, and that literally describes exactly what the nature of the company's business is all about. So they'll literally tell you very explicitly what they sell, whether they sell products, do they sell services. Sometimes they'll give you a bit of background as to how long they've been in business. It's really good information, and I've never found information as informative as item 1 of business. in part ones of these 10Ks. They're all very similar. They're obligated to be similar according to the rules of the SEC, which are basically the stock police. And then item 1A are the risk factors. Now, this is where management is the most honest with us value investors and investors as a whole, because management will look at risk factors and they'll, they're obligated to write out exactly what it is they're looking out for. So in Apple's case, if I remember clearly, as a matter of fact, I know that, the space that they operate in is the tech industry. And the tech industry does not experience iterative changes like maybe the railroad industry did in the 20th century. In the tech space, the changes, when they do occur, are violent. They're rapid, they're expansive, and there's no real signals for the changes. No one can really anticipate how the technological industry in the Western world is going to change. It's just the nature of the innovations. So that's definitely a risk to Apple's business, because if there is a company that can outperform, if this company has some research and development that's excellent, they bring that product or service to market, and then it looks like they're doing it way better than Apple. A lot of times that happens very fast. So a couple other things on here that we'll take a look at beyond item 1 and 1A are item 8. So we're not going to be looking at item 8 in this live session, but item 8 is where I would direct you guys to all go if you're interested or curious in any particular company, because item 8 is going to have the exact figures for the fiscal year performance. We're talking the financial statements. Excuse me. So things like their balance sheet, their income statement, cash flows. Cash flows are very important. So you want to take a look at that. And then I want to give you guys an itinerary as to what else we're going to be looking at today. We're going to go to macrotrends.com after we're done here with the 10K. We're going to look at some profit margins, current ratio, debt to equity. We'll talk about what those mean and specifically what it means for Apple and how their performance played out. And then we're going to go to readyratios.com, because readyratios.com will have the industry comparison. So they'll have other companies that are performing similarly in their same industry, and we're able to make the comparison between Apple's performance and the company X's performance, and we can see how Apple really is performing. And then lastly, I want to give you guys some back-end access to the Excel files that I create for the intrinsic value videos that I upload onto YouTube. I think that that's going to be helpful in at least relaying exactly how I conduct these analyses. I think I owe it to you guys to be transparent about the mathematics behind the intrinsic value calculation, balance sheet numbers, all that good stuff. So we'll get started now. So first off is the business. So how does Apple describe themselves? Well, we'll read it verbatim. It's very short, sweet, and I think it gets right to the point. Apple says that their company background is the following. The company designs, manufactures, and markets smartphones, personal computers, tablets, wearables, and accessories, and sells a variety of related services. The company's fiscal year is the typically 52, week period that ends on the last Saturday of September. The company is based in California, established in 1977. And the products that they sell, the main products, are the iPhone, Mac, iPad, and wearables. And wearables include a myriad of different products that they hold trademarks for, copyrights. And then the other major component are services, right? So there's an excellent book. As a matter of fact, let me get it for you guys. There's an excellent book that I finished reading that really talks about the type of space that Apple is in. There it is. So it's this book right here. This book is called Modern Monopolies by Mozed and Johnson. Now, their copyright here is, what it takes to dominate the 21st century. There's a lot of barriers to entry to dominate the 21st century, as they say, but Apple is definitely doing it, and this much is evident where you can see that they really are dominating the industry on the basis of their market capitalization, which the last time I checked was $2.26 trillion. That's huge, and that's the biggest company by market cap in existence, at least as far as I know, if nothing has changed in the past couple of days. And the reason for that is because of the way they positioned themselves in the 70s. And this was on behalf of the CEO, Steve Jobs, where he created an operating system that was exclusive and that denied access to customers as far as making customizations, and that really set the stage for the exclusivity of the Apple market. If you read the book, you'll see that the services, even though it says advertising here and a host of other things, one of the main ways that they were able to corner the market was by basically setting it up so that developers, and I'm doing a bad job of explaining this. This is really over a span of decades that they've done this. But basically, they have developers and then they have customers, and they only allow them to operate or exchange value on their market, on the Apple market. And they even have their own operating system. They have their own script, their own programming language that is that that developers can use to create applications and what have you. And that's a very interesting and powerful way that they've been able to corner the market and take advantage of, really mop up a lot of value that's out there as far as games, applications, music, etc. So maybe we'll get to that, to explaining more on that in a later video. But I want to finish up the business portion of this 10K. So they do Apple Care, cloud services, digital content, and payment services, which is, that's excellent. Let's take a look at competition. So the way they describe their competition is that the products and services that they offer are in a highly competitive industry, highly competitive environment. And it's characterized by aggressive price competition, resulting in downward pressure on gross margins. And this highlights the importance of their brand. Their brand is what's really doing the heavy lifting here as far as keeping their gross margins intact. We'll push forward to the second paragraph. It says that the company's ability to compete successfully depends heavily on ensuring the continuing and timely introduction of innovative new products. Excuse me. Now that's very important because if you do research, you'll see that folks in the tech space, as well as individuals or companies rather in the pharmaceutical space, they have a very hard time with making sure that their products and services are profitable, only because the research and development that's involved in ensuring the products or services profitability can sometimes be incredibly expensive. Well, not sometimes. Usually, it is incredibly expensive, and the revenues have to be researched, or rather, the prices have to be researched just right, and the marketing has to be positioned appropriately. There's a lot that goes into it, but if the product or service ultimately ends up being a bust, then you have all this research and development cost, all this R&D spend that you now have to pay out of pocket. So that's why they mentioned that it's, innovation is incredibly important, and really innovating the correct way and anticipating customer desire, customer want. We'll push forward. The company believes it is unique in the sense that it designs and develops nearly the entire solution for its products, including the hardware, operating system, numerous software applications, and related services. Principal competitive factors important to the company include price, product, and service features, including security features, price, performance, etc. So I think that's pretty interesting commentary with regard to competition. Let's see if there's anything else of value to be had in the business section. So here's the piece under research and development that I've seen time and time again with a lot of companies who have a high R&D need, high R&D cost. Pharmaceuticals are in the same predicament as technological companies, tech companies. Apple goes on to say that because the industries in which the company competes are characterized by rapid technological advances, the company's ability to compete successfully depends upon its ability to ensure a continual and timely flow of competitive products, services, technologies to the marketplace. The company continues to develop new technologies to enhance existing products and services, and to expand the range of its offerings through research and development, intellectual property, which is huge, and acquisition of third-party businesses who are competing with Apple. So that piece is just reiterating what we were talking about a moment ago. We'll skip over IP. Let's see. Another interesting piece here is 147,000 employees is an impressive feat. That's massive. Let's see if there's anything else of value to be had. No. So we'll wrap up with item 1. That was business. So that just generally describes the business, the market, competition. Now we'll talk about some threats. So this is, if you're just joining, this is the 10K of Apple. We're doing a deep dive into Apple, and we're now transitioning from the business section of the 10K to item 1A, which will define, well, Apple will define the risk factors associated with doing their type of business. Up next after this, if you guys remember, is going to be macro trends, where we'll take a look at some financial ratios. So risk factors, they start off by with a preface, and that preface basically just makes a comment on the fact that it's forward-looking. So risk is in the future, and we don't know if these things might or might not happen. But let's just read a bit as to what they regard as risk. So the business, financial condition, etc., can be affected by a number of factors, whether currently known or unknown, including but not limited to those described below. And the number one thing on here was COVID-19. Now, who could have predicted COVID-19? This is, and I don't like talking about COVID-19 in any sense other than grief or remorse, but this is the reason why the intrinsic value range is so important. And I know it's shocking to see that the intrinsic value range that I publish on a lot of these videos is typically depressed and lower than the share price that these companies trade for. But there's a reason for that, and it's because a lot of American companies are incredibly overpriced. Warren Buffett talks about this in annual statements, several annual statements from Berkshire Hathaway, where he mentioned that he's been sitting on a pile of cash for years, patiently waiting for the right opportunity to fall on his desk, or for him to find it, because it's just not worth your while. It's not worth buying a company, regardless of how powerful. It's not worth your while buying a company that's incredibly overpriced, because you're not going to get a good return. That's why we buy these stocks. So let's see. COVID-19 has spread rapidly throughout the world, prompting governments and businesses to take unprecedented measure in response. Excuse me. Some measures have included restrictions on travel and business operations, temporary closures of business, quarantines, shelter in place. Horrible. COVID-19 pandemic has significantly curtailed global economic activity. And of course, this is a bad thing for Apple. The company is continuing to monitor the situation and take appropriate action in accordance with the recommendations and requirements of relevant authorities. To the extent COVID-19 pandemic adversely affects the company's business, the results, financial condition, etc., may also have the effect of heightening many of the other risks described in this risk section. So that's a very important preface. And keep that in mind, guys, in the future. We never know when another, God forbid, we never know when another COVID-19 or some unexpected tragedy might occur to our world. So that's why we have to be conservative in our valuation. Let me just take a look at the live stream here and make sure we're doing okay. Okay, let's see. Okay, we're doing good. And hello to the folks who are joining. Let me push forward. So we'll talk about the top 3 risks, and then we'll move on to a different portion of this 10K statement for Apple. Now the company, they're saying global and regional economic conditions could materially adversely affect the company's business, results of operations, financial condition, etc. Those are all synonyms for the same thing. The company has significant international operations with sales outside the U.S., representing a majority of the company's total net sales. So basically, they're saying if something goes wrong outside the jurisdiction of the United States, well, they're screwed. Adverse macroeconomic conditions, including inflation, slower growth or recession, new or increased tariffs or other barriers, could materially affect the company. I mean, reading this stuff, it sounds like, oh, wow, I really don't want to invest in Apple anymore. Don't harbor that sentiment. Excuse me. I just smashed a whole bunch of Chipotle. So I shouldn't have done that before this live stream, but here we are now. We're doing it. I couldn't wait any longer. We had to do it today. It was really good too. If you're wondering, I had a double wrapped bean burrito, black beans with that tofu meat that they have, all a whole bunch of veggies. It was excellent. Um, Distraction. We'll push forward. So the macroeconomic conditions, like inflation and stuff like that, that'll affect the company, which is obvious. That'll affect any company, but they have to make it explicit, and it's good that we know, because if they're not writing this out and making it explicit, then I have questions for management. Like, do they know that this is going to affect their company? And you would be surprised, guys. Um, some of these 10Ks that I've read, they I don't know who wrote them, because they don't seem to have a comprehensive approach to identifying risk and writing out the the 10K statement. Now, the next one is global markets for the company's products and services are highly competitive and subject to rapid technological change. This is like the third time that Apple has mentioned this. And I think it's like the 10th time that I've said this on this channel. This is definitely a reason why I don't particularly like investing in tech companies, because it's very hard to predict their profitability and ability to increase the worth of the stock that you may or may not purchase. And it's also difficult to predict how long, if you are winning, let's say you buy in at a good price, if you are winning, how long is it going to take before somebody takes the throne and undermines them and takes their customers with a 10 times, 100 times better product. It's difficult. And that's why Warren Buffett says don't invest in anything unless you understand it. Because if you understand it, then that in and of itself is a moat, a protection against loss. And the number one tenet, the most important thing in value investing, is never lose. So if you don't particularly understand Apple's business, and I'm not saying I fully understand it, I understand it, I would say this much. It's really a superficial understanding. I would definitely say stay away from companies that you have less of an understanding, and kind of dive into companies that you can dig your heels into. Let's push forward. We discussed that at length. To remain competitive and stimulate customer demand, the company must successfully manage frequent introductions and transitions of products and services. That can be tough. That can be tough because you could have cannibalization of, if you introduce a product alongside another one, you could have something called cannibalization of the products, which is basically, customers, let's say you have an iPhone and an iPad, right? You have your iPhone, it's 2007, 2008, whatever, and then you introduce the iPad in 2009 alongside your iPhone. Well, funny enough, you were expecting $1 million in sales from your iPhone in the year that you introduced your iPad, but unfortunately for you, it only did the iPhone only did $500,000, and the iPad did less than you thought it would. Well, that's because customers were only ever willing to buy one product. They only had deep enough pockets for one product, not two. So some managers, this doesn't happen so much at this large corporate level, since there's so many MBAs working at the company, but really on Main Street, on a smaller scale level, this will happen to smaller companies where they think that if they launch two products, that their customers are going to buy product A and product B, when unfortunately if you launch product B, it'll cannibalize the sales of product A, leaving you with a lower revenue and consequently a lower net profit overall at the end of the fiscal year. So it's definitely something tough to navigate. Let's see if there's anything else interesting on here. Carriers, wholesalers, no, we're looking good with this. So we can push forward. I want to go to page 23, where we talk about Apple's going to talk about management accountability. Let's go to page 23. Nice. Okay. So item 7 is management's discussion and analysis of the financial condition and results of operations. Now, they say that this item 7 should be read in conjunction with item 8, which contains the financial statements of the company. So things like revenue, the income statement, cash balance, the balance sheet, rather, cash flows, etc. So I'm going to go over that with you guys at length after we're done here with the 10K. But let's actually read what Apple's management has to say about about their results in 2020. So we'll talk. We already talked about COVID. They're mentioning COVID again because that was incredibly important. So they say here, we'll start from this piece. So during 2020, aspects of the company's business were adversely affected by the COVID-19 pandemic, but not by much, not by much. And you guys would be surprised if you don't know their performance. They did all right. They did excellent, actually. So with many of the company's retail stores as well as channel partners, points of sale temporarily closed at various times, the vast majority of the company's employees working remotely. Companies reopened some of its offices, um, and they're pushing forward with that. Let's see what else. The company believes its existing balances of cash, cash equivalents, and marketable securities, along with commercial paper and other short-term liquidity arrangements, will be sufficient to satisfy its working capital needs. Well, that's excellent. That's very important. Let's push forward here. There's a couple other things I want to take a look at. So we'll look at these changes here. So from 2018 to 2019 to 2020, we'll look at the net sales of their major products and services. And something that I wrote down here that I wanted to go over with you guys was that it looks like, which one was it? So it looks like the change in wearables from 2019 to 2020, percentage-wise was lower than here. But take a look at this raw number as a whole. I mean, this is basically a doubling in 2 years, which may provide some indication as to where the industry is going as a whole. I think wearables are going to be a larger and an ever-growing component of net sales as a whole, and that says something about our the state of our where we're at as far as society. I just think it's pretty cool that people are starting to wear technology more on their body. If you guys know Michio Kaku talks a lot about this. He's a futurist, and he mentions that in the future there's going to be the Internet of Things, and your toilet's going to talk to you, your refrigerator. You're going to have smart T-shirts. So I think that's pretty cool. We'll take a look as well at the iPhone, and curious enough, iPhone sales are slowing. I'm kind of This is a disappointing figure here. Negative, slightly negative, neutral. Um, we know the direction of where iPhone is going. It's not going in the positive direction. It's going in the negative direction. Mac is increasing. So year over year, from 2019 to 2020, 11% increase. That's interesting. Let's see what else we got going on here. Let's just talk about where they sell. Nothing interesting here. We'll talk more about this in a moment. Here we go. So I want to make a comment on research and development. This is incredibly important for a company like Apple. They mentioned that the year-over-year growth in research and development expense in 2020 was driven primarily by increases in headcount-related expenses. What a curious phrase. Let's divulge or read a little deeper as to what they mean. The company continues to believe that the focused investments in R&D are critical to its future growth and competitive position in the marketplace, and to the development of new and updated products and services that are central to the company's core business strategy. I mean, this can't be said enough. Research and development is incredibly huge, and guys, it's a crapshoot. If you really think about it, I know Apple is the largest organization in the United States, at filming, but we don't know if this is going to change. This may or may not change in the future, depending on whether or not the research and development is successful, because there's somebody who has to do the research. They have to do the research accurately, and then they have to spend all this money to develop on the basis of that gentleman or lady's research and where they think the industry is heading. So we needed to understate that, or underline that rather. Let's see. So they talk about the year-over-year in underselling and general administrative expense here on page 26. The year-over-year growth in selling, general, and administrative expense in 2020 was driven primarily by increases in headcount-related expenses, higher spending on marketing and advertising, and higher variable selling expense. Now, this is curious because, as you'll see in a moment on macro trends, the the net profit margin and the gross profit margin, those are staying relatively flat in the last couple of years, but the operating margins are decreasing. And, excuse me, Apple was kind enough to express or talk about the reason as to exactly why that's going on here. It's because of headcount. Um, and that's curious because you'd think as a tech company, how could they have, or why are they continuing to add human beings or salary expense to a tech company that should be looking to increase efficiencies, leveraging technology? If you look at a company like Lemonade in New York City, they are a fledgling insurance company founded, I think, in 2017, and their competitive position is that they only have administrative expenses on the whole. They don't have folks answering the phones. You compare that to someone like Geico, or you compare that to a company like State Farm. Geico and State Farm have maybe 40,000, 50,000 employees answering the phones. They have claim service, regular service. They have adjusters that go out and look at body damage, car body damage to determine how much they're going to pay. They have underwriters, and Lemonade leverages technology and handles all these processes online. So for claims, they have human, their customers go online to their user interface, and then they just put in the claim, submit it. Underwriters, that happens automatically using algorithms. I mean, it's a quite an interesting and beautiful system. And we'll see where Lemonade ends up in the market as a whole. But that commentary was to abet the commentary here, which is if their headcount is increasing, how much more is it going to increase? These are expenses, and this is deteriorating their net profits. So, I'd be curious to see why that's going on. If I had an executive in front of me, I would just be curious as to why. Are there opportunities to leverage technology to keep the headcount depressed? Because in 2009, you'll see in a moment, in 2009, they didn't hire at all. So management was able to get a tight grip on employee hiring, but it seems like it's been increasing ever since. So we'll dive into that a little bit later. Let's see where else we're looking at here. So they just talk about debt, contractual obligations, the revenue recognition principle. Okay, so we're looking good. We're all set here. Let's move on to macro trends. And we will start with the price. So if you're unfamiliar with macro trends, matter of fact, if you're just joining, welcome to the stream. My name is Brenden. We're just looking at Apple, and we're doing a deeper dive, doing what I can't do in the videos that I publish to YouTube. I wanted to have a more personal, connection with you guys in a live setting. And I'm taking a look at who we got here, and we got three folks. Let's see, we have Mauricio. What's going on, brother? And then Certifan1 is saying, I buy Xiaomi stocks, the new Apple from China. That's interesting. I'd be curious to look into Xiaomi. Phil Boy, he's asking, what do you think about ARK ETF stocks? I'd be curious to look into that too. ETFs are exchange traded funds. Those are interesting. That setup is very interesting. Teladoc, CRISPR, cool. Thanks for. Let me write a little something in the chat here. Nice. Thanks, guys, for participating. When I get bigger, maybe I'll have some what do you call them, moderators. That way I can just focus on the live stream, and then the moderators will yell at me and tell me, hey, you got somebody making a request. So appreciate you guys for showing support in the chat. We'll push forward on macro trends. And hello to my high school buddy Mauricio, by the way. What's going on, man? So let's see. So Apple stock price. I want to first. So this looks very geometric and exponential in nature. Let's take a look first at the intrinsic value range to ground ourselves. Now, this is using the most recent figures that were published by Apple, right? So the 2020 fiscal performance is included in this range. Now, I have Apple ranged in value from $237 to $52.13. Now, when was the last time that they were in range? Well, if we use this tool, it looks like it was back in September of 2019. And funny enough, it looks like this is where the start of this increasingly exponential and, in my opinion, rather unsustainable increase of price starts to occur. And I find that curious because, you have to understand that the market is rational to some extent. I understand, and I'm a very skeptical person, but there is a bit of rationality to the market, and the market in an ideal setting. When is it ever ideal? But in an ideal setting, the market should reflect the company's actual financial performance. Now, it doesn't because of overzealous folks who pour money into stocks without doing research. And as a matter of fact, I think that this is what's happening here, is that individuals are just pouring money into Apple. I understand that they're a high-performing company, but are they really worth these high figures? I'm not entirely sure. I'm not sold. I'm not sold on that. I think that they're worth here in the $50, $60 range. I would seriously consider an investment in Apple, but at these prices, no. And I'd like to preface this by saying that this is adjusted for the recent split that Apple underwent a couple months ago. This goes back all the way to 1985. Wouldn't it have been nice to buy Apple stock back when it was trading at 5-6 cents per share? That'd be nice. Let's take a look at the profit margins. So we'll scroll up to the top and we'll go to margins. And then we'll go to profit margins. This is what I was talking about earlier. And I found it curious that even management spoke about it. I actually just noticed the note that management had placed in the 10K in this stream just now. I noticed that this trend, this decrease here in the operating margin before then, is if you look, you got gross is flat, gross profit margin is flat. This represents the money that Apple is making after cost of goods sold, right? So whatever it costs them to make their product, make their service, you take your revenue, you subtract the cost of goods sold, and then you get your gross profit margin. It's just that figure, right? The gross profit divided by your revenue. And they're about 38%, which is excellent. That's really good. I mean, if you can keep 2/4 of every dollar that you make from customers, just about 2/4, for after you consider cost of goods sold, that's excellent. Let's dive past operating margin and go to net profit margin. And these guys have some seriously strong net profits. I mean, this is almost unheard of in any industry. 20% profit margins are incredible. That means that they're keeping 2 dimes off of every dollar that customers give them. And this is after taxes, operational expenses, cost of goods sold, interest expense, the whole gambit. The whole gamut. Huge. But now, why is this going down, right? So why is operating margins, why are they slightly depressing? And this is concerning because operating margins are this is the profit that they make after operational expense. And who's responsible for operational expense? Management. Management's responsible for operational expense, and they should be the ones who are stewarding this operating profit margin here. And I'm not sure that they're doing the best job, at least in this regard. I'm not entirely sure why this is happening, but I just find it curious. It might be a sign of what's to come. I'm not entirely sure. But we'll push forward. What else do we have? Let's look at some other ratios. So let's take a look at the current ratio. Current ratio is current assets divided by current liabilities. And because of the way the calculation is set up, you always want to see it at greater than 1, because then that would mean that, let's say it was at $1.50. So for every dollar in current liabilities, Apple would have $1.50 in current assets. If the company got all its notes called, they would have $1.50 to pay off their short-term debt. Short-term debt is considered anything less than a year. Same thing with short-term assets too. Anything that's realizable within a year. So we're talking cash and cash equivalents. Inventory is considered a current asset. In most industries and companies, accounts receivable is also considered a current asset. Typically, you can materialize accounts receivable within 3 to 6 months. But we'll take a look at the current ratio over time. All right, so remember, this has got to be over 1, and they're solid for the last 15 years. It got really scary here. I don't know what happened in 2015. The American economy as a whole really had a rally from about 2011, 2012, up until the unfortunate COVID event that has scarred our world. So I don't really know what happened in 2014, 2015. They've come dangerously close to not having enough money to cover their current liabilities if their notes were called. But yeah, they just keep pushing forward. They've gotten a little better in 2019 and 2020. Maybe they got a bit more conservative and they realized that they were playing it a little too tight. We'll take a look at the next ratio, which is going to be the debt to equity ratio. Excuse me if I'm looking down here. I just got my notes. We'll take a look at the debt to equity ratio. Now, for debt to equity ratios, we want to see this less than 1. And the reason is just because of the way the equation's set up. So you have your debt in the numerator and then your equity in the denominator, right? So, you typically want to have more equity than debt. So let's say you had $1 of debt and you had $2 of equity. Well, that would be 50%, right, as a proportion. So anything less than 1, we're looking excellent. If it's beyond 1, then that means that the debt has increased larger than the equity. Equity, keep in mind, is basically just the net worth of net worth of the company. So it's simply all their assets minus all their liabilities, and it's the residual interest, right? This is the technical definition, the residual interest that the company stockholders maintain after all debts are paid. So with keeping in mind that we want to have the debt to equity ratio less than 1, look at what's happening here. This is another interesting and strange sign. You got a lot of guys who are bullish on Apple, and I'm sure there's a couple folks who watch my videos and they say, "Well, it's Brenden, your $52.13 figure is way too conservative." But is it though? Look at this. This is very concerning. Very concerning. I mean, I like to keep an owner-centric perspective when I'm considering or fielding any investment. Right? What do I mean by that? I like to think as if I were buying the entire company, not just buying a non-controlling stake or some fraction of the company, because to some extent you're purchasing risk. Well, not to some extent, you are purchasing risk proportional to your investment. So you need to make sure that the company that you're investing in is not going to flush your dollars down the drain in some liquidity event. And 9 times out of 10, bankruptcies and liquidity occurs because of debt. If you watch my last video, I go into detail about how there was a 1,400-year-old company, one of the oldest companies in existence, went into bankruptcy in 2012. And why? Because the family at the time, the 6th or 7th family in the generations of families that owned the company, thought that they needed to expand much faster than they could afford. Not a good idea. They ended up going into bankruptcy and being sold out for the first time in their 1,400-year existence. That's sad. That's sad. Companies don't have to go through that. But they get greedy. And I know there's some finance gurus out there, right? The finance folks. And they say, well, they're a mature company. They're no longer a growth company. Apple is. And when you're a mature company, you should be looking for opportunities to expand and deploy capital in the same or efficient way that we've been doing it, so that we can continue to take advantage of the market and gain market share. I don't believe in that, not 1 second. The moment you start thinking that you're a mature company and you stop thinking that you're a growth company, That's stupid. Growth companies, if you're not familiar, growth companies typically maintain or they should maintain a perspective of using equity only to make acquisitions or to expand the business, right? So we're talking cash, founder cash. They shouldn't use debt because they're just not in a position to feel the debt interest. Let's go back to Apple here for a second. Look at what they're doing. So it looks like they're taking advice, poor advice, probably from these finance folks, and they're expanding beyond their means. The debt to equity ratio has breached 1 here since September of 2019. And really, I don't know why. Maybe it's because maybe this is in response, right, to the bullish price that share price that Apple's experiencing. Because at the same time, at the same time that they breached 1 here in the debt to equity ratio, that's when the price shot up exponentially. So maybe management got loose in their strategy, and they started pushing figures beyond their means, pushing their debt beyond their equity, which is never a good sign. This is almost a surefire way to get into some hot water, get into some trouble. Let's push forward. So one cool thing I want to take a look at is the number of employees. We'll go to other metrics here, and we'll look at number of employees. I mentioned this earlier in the stream, that we were going to take a look at this, and management mentioned this as well. They mentioned that one of the reasons why they weren't more profitable was because of headcount, right? So research and development, I guess, costs a lot of money in salary dollars, and look at the behavior of this curve, right, of this bar chart. So 26, 27, or rather 2006, 2007, 2008, looks like in general they're going on up. The crisis hits, and then they stop hiring. So they drop basically to nothing. And then they pick right back up again in 2010, and it's been decreasing ever since. And it looks like they've been steady as far as their employees and hiring. So maybe I wasn't entirely right when I mentioned that they were growing exponentially, and that whole thing about using technology as a way to leverage and protect yourself against the expense of salary dollars. But I just thought that this would be interesting to look at. We'll dive over to readyratios.com for some industry comparison. And let me just check in with the chat. Let's see, we still got a couple folks on here, which is excellent. Thank you for sticking it through with me and having fun on this Friday night. I figure what better way to spend the Friday night than to be looking at some numbers and learning more about investment. I read a book. It was The Millionaire Next Door by Professor Stanley, who is no longer with us. If you don't know, he passed away in a car accident. Not his fault. And I thought that the book was going to be something ridiculous, like maybe some, I don't know, multi-level marketing or whatever. I thought, let me give it a shot. The Millionaire Next Door. And it was replete with statistics on millionaire behavior. And one of the things that Professor Thomas Stanley said, the gentleman who wrote the book, he has his PhD, I believe in economics, he said that millionaires spend an inordinate amount of time on analyzing and researching their investments. And if you compare that to folks who have median income or income beneath the median for their region, those same people spend much more time on other things like entertainment, receiving services, and what have you. So I do find this exercise to be incredibly important, and I'm happy that you guys are joining me today because it looks like you guys share the sentiment, or you just like chilling with me. And both ways, I don't mind, so it's cool. We'll push forward. We just have one last thing to go through. I know it's 7:49 Eastern time in New York in the evening, but we got this, and then we got. I want to get to the Excel sheet, so we'll kind of rip through this. I'll end this ready ratios portion at about 7:55, and then we'll end off with the Excel sheet. I want to be transparent with you guys on how I do these figures. So let's see. Let's start off with the debt ratio. So we were talking about debt a moment ago. Looks like their debt to equity ratio is kind of acidic right now, in the sense that its debt is so much larger than equity, and it's growing. Their debt is, which is concerning. Liabilities to assets, look at this, 0.74. Liabilities to assets. This is for 2019. Keep that in mind. This is for 2019. Ready Ratios hasn't uploaded 2020's figures yet, but we can still gain value from this. This is just a snapshot. Industry as a whole posted 0.57. What is the industry as a whole? We're talking Dell, Supermicro, Fitbit, Omnicell. These guys are pulling some serious figures here. So and they seem relevant to Apple. Let's see. So 0.57 is what the industry posted. These guys, Apple, are not doing too well. Debt to equity ratio, so that's liabilities to equity. And look at that, 2.8 to an industry standard of 1.04. So that means for every dollar in equity, right, for every dollar in net worth that Apple has, Apple also has $2.80 in debt. Very concerning. Very concerning. This might be the reason why they start to suffer in financial performance in the next 5 years if they don't get a handle on their debt. Not saying it will be. They have an incredibly large moat, a protective barrier when it comes to the network. They experience a lot of network effects. They have a very exclusive customer base. The way they have it set up is excellent. I'm not doubting that, but they got to watch the debt to equity for sure. Current ratio we discussed at length. Of course, they're doing a little bit worse than industry. Let's see, what else? Profit margin. So I went over this in the video, but I'd like to go over this again. Look at how massive this profit margin is. That's huge. 21.5% versus an industry 3.1%. And look, this column on the far right here represents all industries, right? So any company, grocery stores, railroads, spaceships, Elon Musk, what have you. 3.3% in 2019 experienced in one of the strongest years of American business performance of all time. This is pretty regular to have such a low net profit margin. This means here for all companies in the United States, for every dollar received from customers, the companies were able to retain 3.3 cents. And then the companies decide whether they pay that out in the form of dividends or retain a certain amount in retained earnings account. And in Apple's case, they retained 21.5 cents off of every dollar, which is massive. We'll look at the return on assets. I skipped this return on equity, and I'll tell you briefly, it's because sometimes companies have negative equity. And Home Depot has negative equity. And it really pisses me off because, Home Depot is such a strong company, and I love shopping at Home Depot. The stuff that they have there is incredible. But they kind of play with the stock price a bit. They do a lot of stock buybacks. They increase their treasury. I guess they use that as an incentive so they buy back the stock to increase. So they take away the supply from the market, which artificially increases the price of the stock, right? And then they can do whatever the hell they want with the stock that they have in their treasury account. Typically, people just pay it out to management as an incentive to raise the stock price, or they can literally just destroy it and artificially keep the stock price high like that, because these guys buy millions of dollars when they do buybacks. So that's why I skip over return on equity. I can't really measure the performance, the productivity of return on the basis of equity, only because I know I was pretty scarred when I saw Home Depot did that in 2019. They actually have negative stockholders' equity. Bizarre. Anyways, we'll skip over that. Return on assets, we're looking at 16.1% for Apple, which is compared to 5.8% for the industry as a whole. This means that for every dollar that the company owned in assets, Apple, they produced 16.1 cents in net earnings, which they successfully retained. That's solid. That's really good. Let's see what else. Can skip over that. Okay, we're looking good. I don't trust these numbers here, these graphics, by the way, guys. I just look at the raw numbers, and I suggest you do the same. I really don't know how. Ready Ratios isn't that transparent when it comes to how they determine whether they give them a thumbs up or thumbs down. So we'll skip over that. Let's see. The last piece is going to be the Excel sheet. Let's take a look at the Excel sheet. And as a matter of fact, if you are still with me in this live stream, thank you for joining. If you're watching at a later time, thank you for sticking it all the way through. This is one of my favorite things to do in the entire world. I'm sure you can tell. The determining the intrinsic value of companies is very important. Let me pop open the stream here. Yeah, we still got 3 folks. It's very important. I appreciate you guys. It's very important to determine the real value of these companies because we need to check ourselves in times of uh, times where the market posts crazy figures, right? Chapter 8 of this book here talks about that. It talks about Mr. Market and how he'll knock on our door and present us with a price for a stock. And if we purchase that price, then we're just as crazy as everybody else. So we have to make sure we're doing our own analysis and making sure that we're being rational too. We can't contribute to market folly. We have to be responsible and determine who gets our money and who doesn't. So we'll push forward. Let's see. So for revenue, I just want you guys to know that. Let's see. We can push forward. Net profit and cash balance. These are the graphics. Now let's start. Let's start here. So I want to look at the cell referencing for this. We have about 4 minutes left. So this takes this figure and then divides it by this figure, right? So the low end of the intrinsic value is representative of the company's cash. And I'm always saying, for every share issued and outstanding, this represents the company's cash and cash equivalents. Well, it's not entirely true. Well, it is true in the sense that the meaning of it is correct, but the definition is much more specific. If we look at the cell referencing here, and let me just move this little apple thing. Oh, look at that little hidden gem. I bet you guys didn't know that I had that hiding back there. So this is what this cell is referencing. The intrinsic value here is just the shares outstanding, right? But this is in the millions. So this is not 17,528. This is 17,528,000,000. The numerator is also in millions too, so don't worry about that. So, but what is the numerator, right? So it says cash balance reference for the specific sheet, F13. So we'll go to cash balance, and then we will go to F13. So what I do is I use the median of their cash balance performance from 2010 through 2020. And the reason I do this is because this is a conservative way to determine their true cash balance. I can't just choose this last figure here. This is too inflated. I can't choose 2010 either because this is underinflated. So I have to use some statistical center, some descriptor of the center of this data. I don't use average because average will get influenced by outliers like this and outliers like this. So I use the median because it's absolved from outlier effects. This represents a more true center for this data. And curiously enough, when companies do experience strife, they will revert to this statistical center. And Benjamin Graham talks about, actually Benjamin Graham's commentator in this book, who's excellent, if you get the most recent edition, he talks about how that happened in 2002 with, I think it was IBM. A lot of these guys in the dot-com crash thought that they were going to be millionaires overnight, and their dreams all came tumbling down when IBM and others experienced a reversion to a more rational center when it came to their price on the basis of their financial performance. So let's take a look at the high end. So now that we know that this 2,037 cents is basically 41,601,000,000 divided by 17,528,000,000, what's this figure? Well, this is the same. So the denominator is the same, right? Denominator is just $17,528,000,000, right? So that we keep it level. We can compare these two figures. But what is the numerator? So the numerator is the figure found on net profit sheet cell F13 multiplied by 20. We'll talk about this product in a moment, but let's go to sheet net profit cell F13. So sheet net profit cell F13, and look at that. Excuse me. It's the exact same thing as the cash balance, except that it's for net profits, right? So I take the median of 10 years trailing net profit, and then I multiply that by 20, and then I get my figure after I divide it by the total shares outstanding. Now, the reason why I multiply it by 20 is because that should represent the maximum amount of time that we should be willing to wait in order to get back our investment in representative earnings. Now, what do I mean by that? Well, this is a high end it's called high end for a reason. Because really, we shouldn't be investing in companies that experience or have prices that are higher than this. It should be some sweet number in the middle. And if it were the 1930s, then it would be this figure here, the book value per share. Book value per share is a sweetheart ratio from value investing, which basically takes stockholders' equity, which is the net worth of the company, and what is it divided by? It divides it by so intrinsic value, cell B1, divides it by the total shares outstanding. So, that's what Benjamin Graham refers to when he says you should buy a company based off of its book value. This is the price that we should be buying the company for. This is a fair value price. And curious enough, this book value per share for me and my calculations always ends up in the middle of the intrinsic value range, which is confirmatory for me that I know that this is correct. And this, I didn't come up with this. These are suggestions that were provided in Benjamin Graham's book on how to analyze companies rationally. So the fact that you could purchase a company for on the basis of its cash. So if you got the company for lower than $2.37, basically the company's paying you to keep the company, right? Because if you're paying $2.35 a share, and they have $2.37 in their cash vaults per share, and that means that you're getting 2 cents off of every share in the transaction. So this is like bottom of the barrel price, bare minimum, that the stock is worth just based on its liquidity alone, this liquid asset, cash and cash equivalents. And then on the high end, this is using less static and more dynamic figures. This is using the dynamacy that's found on the income statement. Because the income statement is always changing, but it represents the average financial performance for the company over its fiscal year. That's what the income statement measures. But because I don't want to succumb to selection bias, we have to find some statistical method to basically average it out and avoid selection bias. That's why I use, instead of 1 data point, I use 10 plus data points here. Because I want to avoid selection bias, and then I summarize these data points with the median, and then this is how the high end is calculated. So this is based off of business performance. We can dive. There's a lot more that we could do when it comes to analysis with Excel, and maybe I'll talk more about that in another stream. If you guys do want to learn more about how to analyze companies using Excel. It's a very important tool and very powerful tool if you know how to wield it. But we will wrap up for today. This has been very fun for me. It's the first Fundamental Friday, first of many, hopefully. God willing, I'll be able to share with you guys. This is much better than going out for me or partying or drinking and all that stuff. Sharing what interests me so much with you guys is really what I live for. This has been truly a very happy reprieve from outside life. So thank you guys for making it so enjoyable for me. If you guys have any questions or comments, don't hesitate to put it in the comments section. Got a lot of love for you folks. Have a beautiful rest of your day. Stay safe and keep in touch with me. And I'm going to try to figure out how to close this live stream. See you guys.